Hi everyone, I'm James, market strategist at uSMART Securities, and I will be conducting this 30 minutes webinar starting now. Hope all of you are doing okay. Today I will share why investors are loving McDonald's stock. And we are partnering with SGX for the next two webinars in the Singapore Trading Festival 2023. The Singapore Trading Festival will be held from 25th March to 2nd April, and I'm just going to speak on March 30 and April 1st. They would be about Singapore listed stocks and ETF. The first seminar is March 30th. Topic is which SGS stocks or ETF will benefit from China reopening themes. And the next one will be 1st April, where I'll be sharing how to build a resilient investment portfolio with safe haven Singapore stocks. So stay tuned for that. Let me begin with some disclaimer first. This presentation is for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. And lately, US stock market is quite happening. So I will spend some time on that. And I will also spend more time on one of the best restaurant stocks, McDonald's. Typically, I don't like restaurant stocks because the competition is intense. But I like McDonald's business models, and I also think that I have covered a lot of technology companies in the past. So it's good to know what are those defensive stocks out there. But again, let me begin with US stock market first. US stocks is quite happening lately because of the collapse of Singapore Valley Banks and First Nature Bank, followed by the potential liquidity problem of Credit Suisse and Charles Schwab, which actually dragged the US indices down in the past few days. But the year-to-date performance for S&P 500 is still positive at 1.8%. STI index is negative 2.6%. MSCI China is negative 1.8%. And we could also see that gold is holding up quite well at 5% return. In terms of sector performance, we could see that financial sector is one of the worst performers this year with negative 8% return. It is a broad-based sell-off for financial stocks lately. However, one thing to bear in mind is that during this banking crisis, it did not really drag down other risk-on sectors like technology sector. Tech sector is still up by 12% this year. And I think mainly it's because rate hike expectations are now lower. The 10-year bond yield is lower, so the discount rate for technology companies are lower. So it actually helped push the tech sector overall. Again, I would urge you to have some defensive sector in the first half of 2023. You should have some healthcare, you should have some consumer staple or even utility sector. And just to give you a quick overview of what has happened to the banking stocks lately, especially Silicon Valley Bank, which you may all heard about it in the past 1 week. Firstly, Silicon Valley Bank, SVB, is the 16th largest bank in the US. And as the name suggests, it is best known as the bank for Silicon Valley technology companies. It provides lines of credit to startups and venture capital that other banks typically won't touch. Secondly, the bank received a lot of deposits of about 190 billion by end 2021, and it decided to use most of the customer deposits to invest in 10-year maturity mortgage-backed securities, MBS. Thirdly, the worst thing here is market timing. It invested in MBS when the interest rate environment was still quite low, and now the interest rate is massively higher, and hence it suffered a paper loss. Having said that, it won't be a problem if Silicon Valley Bank just hold the bonds for 10 years because it will get back the principal. But lately, Silvergate went under and Silicon Valley Bank decided to sell some mid-duration securities to improve its liquidity, but incur 1.8 billion loss. And to even make things worse, the bank said that it wanted to raise 3 billion by selling new shares. And every investor just panicked on the news and everyone just sold their shares and withdrew money from the bank, which made Silicon Valley Bank sell more underwater asset in the market in order to fulfill the withdrawal request. So ultimately, Silicon Valley Bank is shut down by regulator. But US regulator also say that it guarantee all the depositors that they can withdraw 100% of their money in the bank, and also say that they will provide similar protection to depositors in other banks to prevent bank runs as well. So in the meantime, if you want to withdraw money in any bank in US, right, typically it's safe because US regulator say that they will guarantee you. All in all, the moral of the story here is Silicon Valley Bank is not doing something fishy. It's not the Lehman Brothers in 2008. So you are not looking at a systemic financial crisis. Silicon Valley Bank makes some bad decisions and run into liquidity problem and eventually collapse. But when you look at Lehman Brothers was over-leveraged and sold a lot of worthless mortgage-backed securities. So I think ultimately the key takeaways here are, firstly, I don't think this is a Lehman moment. It's not a systemic financial crisis. But you may ask, in that case, James, why almost all the banks are coming down in prices? I think the main reason for that is every bank investors are afraid the bank that they invested in at the moment will be the next one to go under. Or suddenly they realize that the rising rate environment is not necessarily good for banks. So they go on a witch hunt to see which banks are having high unrealized loss on the bonds, on the securities itself. So how do you know if the banks that you invested in is safe? There are a lot of different financial metrics, but I will look at held to maturity securities, which are those securities that are expected to be held to maturity. So you can look at what are the unrealized loss of the held to maturity securities, and then you divide it by the tangible common equity. And here will show you that the held to maturity losses of equity is 89% for CharlesShop. And this is why CharlesShop actually fell as much as 30% over the past 1 week, because CharlesShop has one of the highest unrealized held to maturity securities to tangible asset ratio at 89%. So you can look at the list here and see the bank that you're holding, right, is healthy or not. Secondly, we often hear the phrase, Federal Reserve will hike rate until something breaks. And in this case, it's possible that Federal Reserve has broken something in the banking system. This is why a lot of people are saying that Federal Reserve will stop hiking rates soon. And because of this, we are seeing that the rate hike expectation has changed. According to CME FedWatch, Federal Reserve is expected to raise the interest rate by another 25 basis points in March, followed by a 25 basis point reduction in June. And by the end of 2023, you should be seeing 4 rate cuts, which will bring the FOMC rate to 3.75 to 4%. However, I believe that the ripple effect of the collapse of Silicon Valley Bank should be short-lived, and hence the impact towards the rate hike path should also be short-lived. This is why I'm not that optimistic. I see that the rate hike expectation here will change soon. I still see a higher terminal rate, higher than the projected rate here at 4.75 to 5%. Because if you look at 1 week ago or 1.5 weeks ago, the terminal rate is as high as 6%. And I think you should be seeing the terminal rate higher than this. And I think that the banking crisis will pass and people will look at warm inflation number and start to worry about the inflation number again. And I also don't think that Federal Reserve will cut rates 4 times by the end of this year. I do anticipate only 1 rate cut, which is a reduction of 25 basis points at most. And again, why Federal Reserve needs to cut rate this year but not next year is because Federal Reserve needs to cut rate this year to help Biden with his re-elections. And here show you the equity risk premium. Nowadays, I often look at equity risk premium to decide that if now is the market bottom. And we could see that in the past probably 6 days, it has increased from 1.2% to 1.8% here, but still it's not high enough to me. In any case, I think that the S&P 500 is not looking attractive yet. In the past, it has been observed that whenever the equity risk premium reaches close to 6%, the S&P 500 typically hits the bottom. It happens in 2008, 2011, and 2020 as well. So I want to see higher equity risk premium like above 4% and makes the stocks attractive again. And lately, I have been thinking to myself that maybe I am wrong about the market. As you all know, I see market bottoms in the first half of 2023 and start to rally in the second half. And I previously also believed that idea of nimble when the S&P 500 drops to 3,600, bite at 3,300 and gauge at 3,000 points for S&P 500. And just to give you my conclusion first, I think 3,600 might be the market bottom in the first half. I think S&P 500 might go down to near to the previous low to give you the illusion that it will break the October low last year. But ultimately, it will bottom near at the price of 3,600. And how I arrived at this idea is because of the 1980s inflation chart. This is the inflation CPI, and this is the S&P 500. And in 1980s, inflation fell from 14% to 1.5% in 6 years' time. And S&P 500 went up more than 50%. But at the start of the falling inflation, the US stocks first corrected 27% before continuing the rally itself. So I think to myself, if history repeats itself, the correction may be completed when S&P 500 corrected 19% from October to October last year, August to October last year. But if the 20% correction only starts from February high this year, then it also suggests to us that it may go down to 3,350 points at least. But I would just go ahead and say that 3,600 looks likely to be a bottom to me. So meaning to say the last year October low could be the low. And based on technical analysis, firstly, we could also see that S&P 500 recently formed a head and shoulder pattern, and the target price is 3,640, somewhere here. Secondly, if we were to draw a Fibonacci extension by repeating the downtrend over here, we could also see that 161.8% is 3649. Thirdly, it also looks like an inverted head and shoulder in the making at the moment. The left shoulder bottoms at 3636, and if now is trying to form a right shoulder, the bottom could be near to 3636 as well, because the left shoulder and right shoulder should be having the same bottom itself. So overall, all these three charts indicate to me that 3640 or somewhere between 3600 could serve as a strong support level. However, I'd just like to clarify that attempting to predict the market bottom price level is a dynamic thinking process. I might change my view later. So if you want to stay informed about my views and insights, just message me anytime. But currently, I would say that 3600 seems to be the market bottom. I prefer to wait for the price to reach 3600 for S&P 500 and to reassess the market situation before deciding on any new target price. And now let's jump into McDonald's. McDonald's is a fast food restaurant that sells burgers and fries. And I like McDonald's a lot because of its stable revenue stream and defensive business model. For example, post-pandemic, many tech companies' share price dropped. And lately, you could also see that cyclical bank stocks fell as well. But McDonald's is one of the better companies that could cruise through the boom-bust cycle because of its competitive edge itself. Based on Bloomberg consensus, 29 analysts recommend buy, 11 recommend hold, and the 12 months target price is $292, which is an upside potential of 9.7%. Sometimes when I present a company with limited upside potential, like McDonald's, to clients, they would think that maybe it's best to invest in another company with more than 20% upside potential instead. But I think you should ask yourself if you have enough defensive asset in your portfolio. In recent years, whenever S&P 500 has provided negative yearly return, McDonald's always managed to provide a positive return. For example, in 2022, S&P 500 fell by 18%. McDonald's outperformed S&P 500 by near to 19%. So this tells you how defensive McDonald's is. McDonald's is one of the strongest brands in the world. McDonald's is the only restaurant brands among the top 100 best global brand. It's ranked as the 11th best global brand, and with a brand value at 48 billion. And McDonald's accounts for 0.2% of the restaurant market share in terms of the number of locations in the world. And in terms of revenue, McDonald's holds 3.6% market share in the world. McDonald's is typically categorized as consumer discretionary stock, but I personally feel that it's more of a consumer staple stock compared to other consumer staple stocks in a consumer staple ETF, like Estee Lauder, Philip Morris, or Altricia itself. I am a bit puzzled as to why a secret company can be categorized as a consumer staple, and why I think McDonald's is more of a consumer staple stock is because it is recession proof. It is still selling fast food at a cheaper price relative to other restaurants in a recession, and it is collecting stable rental income from other franchisees as well. Yes, a lot of investors would associate McDonald's as a real estate company, and I'm going to explain that to you later. First of all, in May 2014, McDonald's come up with refranchising model. It's basically a strategy involves selling company-owned restaurants to franchisees. To put it simply, McDonald's realized that franchisees bring in more revenue than company-operated restaurant. So McDonald's want more franchisees and one less company-owned restaurant. And this allowed McDonald's to instead focus on the core strengths of marketing, product development, and brand management itself. And by selling off the company-owned restaurant, McDonald's can also reduce the cost associated with managing and operating this location, such as utilities, rent, and labor costs as well. And the ultimate goal here is to have only 5% of his restaurants company-owned, and the remaining 95% will be owned and operated by franchisee itself. In 2014, when they first announced a refranchising model, we could see that franchisee accounted for 81% of the total number of restaurants, and it is standing at 94.77% at the end of 2022. So you could say for now, McDonald's has reached the 95% goal. Nowadays, 38,000 out of 40,000 restaurants are operated by the franchisee itself. The refranchising model has also led to a significant increase in the percentage of revenue generated by franchisee. In 2014, we could see that franchisees generated only 33% of the revenue, whereas in 2022, they generated about 60% itself. On the other hand, the revenue generated by company-owned restaurant has decreased from 66% in 2014 to 37% in 2022. So one key thing you may notice here is that the franchise-operated revenue was larger than the company-operated revenue since 2008 itself. The franchise revenue was 51% of the total revenue. And you could also see that the total revenue in 2022 was 23 billion, which is smaller than 2014, 27 billion itself. So the franchise revenue was growing, but the rate at which the company-operated revenue was declining was even faster. So some people may say that the franchise model, the refranchise model is not so successful, but they are reading it wrongly. Because even though the revenue is slowing down, what I want to show you here is both the operating income and the net income are increasing. Operating income has increased from 8 billion in 2014 to 10 billion in 2022. Net income has increased from 4.7 billion in 2014 to 6 billion in 2022. And the main reason for that is the improvement of profit margin. Improving profit margin is the main reason McDonald's wants more franchise restaurant. Because the franchise model has higher gross restaurant margin at 83%, whereas the company-operated gross margin is only 15% itself. And the franchise gross margin also helped bring the total restaurant gross margin to 57%. Again, not only gross profit margin is improving, since 2014, the operating margin has improved from 29% to 40%. And on the other hand, the net income margin increased from 17% to 26%. Okay. And let me quickly go through the comparable sales. In 2022, the comparable sales increased by 10%. It was lower than 2021, partly because the sales of the company business in Russia has been sold off, and the temporary restaurant closure in Ukraine as well. But this year, China reopening could actually help to push up the comparable sales. And also, let me go through the revenue breakdown to share with you why the franchise margin is so high. It's higher than the company-operated restaurant. Basically, the company revenue consists of the sales by company-operated restaurant and the fees from conventional franchise and developmental licensees and affiliate. The company-operated restaurant just means the restaurant operated by McDonald's themselves. So McDonald's takes all the restaurant revenue. And the revenue from the conventional franchise restaurant include rent, royalties, and the initial franchise fees. The revenues from restaurant license to developmental licensees and affiliates include royalty and initial fees itself. So you could see that the revenue from developmental licensees and the conventional franchise are mostly similar, but exclude the rental revenue. In 2022, franchise restaurant represented 95% of McDonald's restaurants worldwide, and because of that, it typically generated stable, predictable revenue, which is largely a function of franchise sales itself, and also resulting in a lot of cash flow streams. And I want to go in depth to talk about the franchise revenue. There are rents, royalties, and initial setup fees. And we could see that rent as a percentage of the total franchise revenue is 64% in the past 3 years, and loyalty is just about 35%. So suffice to say that franchise model earns McDonald's more on rental income than royalties at 35%. And we could also see that rent as a percentage of total revenue is 39% in 2022, whereas loyalty as a percentage of total revenue is 21%. So suffice to say that McDonald's is almost like a real estate company or a REIT company because it earns about 39% of the total revenue from rents itself given by the franchisee. One important thing to know about the rent is based upon a percentage of the restaurant sales itself, similar to the royalties fees. But even if the franchisee sales are doing badly, they still need to fork out minimum rents payments itself. So this table shows you the future gross minimum rents payment paid to McDonald's under the existing conventional franchise arrangement, which is the minimum rent franchisee pay to McDonald's. In 2023, they are expecting 2.9 billion. So assuming the total rents is still about 9 billion in 2023, then we could say that the minimum rents that McDonald's is supposed to collect is about 32% of the total rent itself. So out of this rent portion, 32% is stable. This is one of the most stable income McDonald's collected. Even if franchise sales is poor, McDonald's is supposed to receive this minimum rent. And if the franchisee business is doing okay, McDonald's will then collect more rents from franchisee itself. So McDonald's is supposed to receive 8 to 15% of the sales in form of rent. It is the percentage of sales that a franchisee pays in rent if the monthly sales exceeds assisted a base sales figure, range from 8% to 15% depending on the acquisition and developmental cost itself. Bear in mind, this is not the latest table because I cannot find the latest one. And how about the loyalty fee? The loyalty fee is estimated at 4% based on the sales. So if you add together the rents that I mentioned one slide earlier, then as a franchisee, every year you need to fork out maybe 13% to 19% of the restaurant sales to McDonald's. In any case, the restaurant sales figure of the franchisee will not be recorded in McDonald's financial report because the restaurant sales of the franchisee is franchisee's revenue. McDonald's will just record the rent and loyalty of the franchisee in their financial statement. And because of this business model, McDonald's is one of the largest landlords. It's estimated that McDonald's owns 50,000 acres of land. McDonald's happens to be one of the largest real estate owners in the world. Typically, McDonald's owns about 70% of the buildings and 45% of the land at its location worldwide. And in 2022, we could see that the value of the land and property increased to approximately 38 billion from 33 billion in 2014 itself. And I also want to look at some of the past performance and the risk metrics as well. So we could see there are two key takeaways here. Firstly, since 1980s, of all the past 43 years, McDonald's outperformed S&P 500 over 24 calendar years itself. And secondly, McDonald's has outperformed S&P 500 in terms of 1 year, 3 year, 5 year, 10-year annualized return itself. For example, the 10-year annualized return for McDonald's is 13.3%. S&P 500 is 11.9%. But from the maximum drawdown and standard deviation, we could see that McDonald's is more volatile. In conclusion, the main reason I like McDonald's is business model. The business model is simple. Basically, McDonald's borrow money to buy land and property, and then find a franchisee in the wait list, ask the franchisee to pay loyalties fees, and force them to rent the McDonald's property. And in the process, McDonald's will earn a high margin from the franchisee, and McDonald's just need to repeat the same process over and over again. So it's like a combination of franchise plus a real estate model. And again, it's not often you can see a restaurant business earning 40% operating margin, as I mentioned earlier, which is a lot better than a lot of technology companies. All in all, I would say that if you are not looking for a high upside company and you just want something that could potentially beat the S&P 500, and in the meantime, you could play defensive because you probably think that the stock market in general looks likely to drop further from now, then I would say that McDonald's is one of the good choices here itself. And yep, that's all from me. And let me know if you have any questions, and also please type your questions, if any, in the Q&A box itself. Okay, so what is the intrinsic value for McDonald's? So I would say that based on the slides earlier, we could see that based on Bloomberg consensus, people are giving it about 10% upside from now. So they are predicting a target price of about $292, if I remember correctly. Yeah. Okay. Does McDonald's give good dividends? If I'm not mistaken, it's about 2.3%. It always range about 2 to 3 point something percent itself. But again, normally when I go invest in a US stock, I won't look at dividend itself because remember, as a foreign investor, you need to pay 30% dividend withholding tax. Okay, when is Chick-fil-A going to IPO? Okay, this is a good question. I would say not anytime soon. And for the benefit of the audience, probably let me share what is Chick-fil-A, if I pronounce it correctly. It's a fast food restaurant similar to McDonald's, sell fries and burgers, and probably more popular lately. And as is reported in the media, it's longer queue during the peak hours. It is a family-owned business, and I think the founder died in 2014. And when he died, he made his children sign a contract that say that they can sell the company, but it can never go public. It can never go IPO. So I would say that probably not anytime soon to go IPO, but if you are looking for a better fast food restaurant, I would say that you are stuck with McDonald's. McDonald's is still one of the best choices out there at the moment. Okay. How can I invest in S&P 500? You can purchase the ETF, for example, SPY or BOO. I personally prefer SPY because the AUM is bigger, is the largest, and the liquidity is the best as well. Okay, could you share your opinion on Starbucks? Okay, I don't really have an opinion on Starbucks because I simply don't like their coffee. And I can't seem to convince myself to research on the company or invest in the company because I don't like the coffee. So I don't like the products. I find it very difficult to like the company. So I do not research much on that. But I guess the excitement now for Starbucks is China reopening. And we could also see that Starbucks is having better comparable sales. But probably if we were to look at the valuations itself, the valuations is still looking a bit expensive at more than 30 times compared to McDonald's 25 times. All in all, I would say that I don't have a conclusive opinion on Starbucks yet. But normally when I look at other funds holding in the fast food, franchise, food and beverage industry, I would say that I see a lot. Active fund managers normally will own Yum Brand, McDonald's, Texas Roadhouse, and Starbucks. So I think Starbucks is one of the popular choices among those active fund managers. You can take that as a reference. Okay, when do you think S&P 500 will bottom? If I were to guess, it's either March, but probably it won't bottom in March and April because based on seasonality, March and April are normally a positive months. So in the past, beginning of may start to have a sell down. So I would say probably May would see the market bottom because of seasonality, if I were to guess. Yeah. Is now a good time to buy Credit Suisse? Okay, again, a good question. I think you should avoid Credit Suisse by all means. If you were to look at yesterday's news about the Saudi National Bank, that they say that they won't provide any further financial help for Credit Suisse itself, right, and cause the market panic, I think it is not a bad news, because Saudi National Bank also give an explanation to that say that due to regulatory issue, they won't be able to buy more than 10%, whereas they are holding 9.9% of Credit Suisse now. And this morning, we could also hear that Credit Suisse has borrowed about 50 billion Swiss franc from the central bank to boost its liquidity. But the problem here is the bank has been plagued with financial losses and a lot of scandals in the past 1 or 2 years. And if you were to look at the financial reporting yesterday night, the bank actually say that they found material weakness in the internal control over the financial reporting over the past 2 years. So to me, the Credit Suisse CEO cannot just say that they don't have any liquidity problem, they don't have any liquidity issue, when the financial statement itself, right, is not so reliable. So I won't advise any bottom fishing if that is what you are asking. Okay, so yeah, I see a lot more questions, but we are running out of time. I will try to answer those questions in the comment sections once I post the videos on YouTube, so look out for that. Again, thank you for coming. I will see you soon.